Welcome back to Mostly Growth, the number one podcast in product monetization. CJ, you're back on the East Coast.
I'm like Worldwide West. I'm like Pitbull, Mr. Worldwide.
You're like Carmen Sandiego.
I'm technically still in the same country, but yeah, I was out in San Francisco. We did a dinner for 25 CFOs at Alora, which is on the Embarcadero. Is that how you say it? Embarcadero. The Embarco.
I'm going to take your word for that. Is it back?
Oh, we are so back. It's also like, I think cleaner. There aren't people running around trying to just like fight you or like throw trash at you. So like that part's better. And then we did a happy hour the second night. We thought it was going to be like this cool venue where it felt like you were in like a speakeasy, like downstairs. You had to actually enter through like this bookcase that was like pulled aside. But like they ended up keeping the door open. So now you're just walking down into kind of like a creepy basement. You got down there. Definitely had more frat vibes than speakeasy. But hey, you come for the people, right? Not for the ambiance.
In the top secret safe room. I don't know what goes down in here, but... Dun, 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 dun.
Oh man, I'm just picturing like a dark room when you would just invite a bunch of CFOs who start turning on the cell phone like flashlight and are like, I can't see anything.
That's so mean, but so on brand.
I mean, am I wrong?
Am I wrong? There was a consistent theme amongst all the people that I met with. So I did these 2 CFO events, finance leadership events, but I'm out there, so, right? So I may as well just meet with all the people that I haven't seen in a while. And so I also met with a friend who is managing director at a big bank. He does tech stuff. And then I met with a VC friend who does investing. And there was just like this consistent, I don't know if I would call it anxiety or malaise, but like this just feeling of, I don't know if I'm working on the right shit right now. And I don't know. I just wanted to call it out because there's been a lot of stuff going back on and forth on Twitter. And I actually didn't see that thread that went viral about like the permanent underclass, what the guy had said. Like, woo, I hadn't seen that like when I started to think about this and write about this, but there's definitely like this, and I hate the word vibe, but there's definitely like a vibe or a sentiment shift going on.
Yeah, there definitely seems to be. And the tweet you're mentioning was from Didi Das, partner at Menlo, talking about how there's a group of about 10,000 people who over the last 5 years have hit retirement wealth of like well above 20 million. But then there's a lot more people that thought they were going to hit the lottery and didn't, frankly.
When I was having breakfast with my banker friend, he said Anthropic just ran a secondary. They capped it at $30 million per person because you have to put guardrails around it. He said 75 people hit the 30 million.
Oh, man. Have fun in the San Francisco housing market.
Yeah, right. You're going to live in a hovel. But like, just to go through like 3 anecdotes. And, you know, anecdotes are what they are. They're a point in time. It's a conversation. It's not necessarily everybody feeling this. But CFO of a $50 million SaaS company, right? He's sitting next to me at dinner. Kyle, he's 6 years into this journey.
Is it venture-backed company, PE-backed?
It's venture-backed right now.
Okay, venture-backed, 50 million ARR, which a few years ago, that was the dream. That's like where you want to work.
And he's legit. And he's saying to me, you know, I think, CJ, we're going to exit. We're having the preliminary conversations about exiting and hiring a banker in our next board meeting. I'm still thinking about leaving to try to hop onto one of these AI rocket ships. I've been here for 6 years. I could hear him like going through the thought process in his head, and I saw both sides of it. But he's doing the net present value with a tinge of FOMO on if he should stick it out. And once again, it's not a certain thing that they're going to exit, Kyle, but it's more likely now than it was before. And he hasn't exited a company yet, so it would be good for him.
But that is the question, like, who is buying a 50 million ARR SaaS company right now, and who's paying a strategic multiple on it? And so his job is going to be way harder. Probably people are going to be unhappy with him for not being able to sell it for a higher price. And yeah, I mean, his equity is probably not going to be worth what it was at its peak.
I think he thought that this was going to be a company that was going to exit for $1 billion a year ago.
And now what do you think it's worth?
He was hoping for 300.
That is quite a step down. Well, hopefully they don't have too much of a preference stack on the business too.
And that's the part that I don't know, right? I don't know how he's calculating his own piece of that, but also like you want to have an exit to something that you've started, right? It feels good just to complete the loop.
Although I do hope he asks his board for a carve out.
Yes. Yeah, he should. So that's the first one. The second anecdote of mine is my banker friend. And I met him back in the day when I was at Sneak. Back then, we all thought we were going to go public. And I thought that maybe we'd be working with him. But either way, we're good friends now. And we always talk about what's going on within cybersecurity. He had like a vulnerable moment where he was like, dude, I'm getting pulled into like all these defense deals that I'm not a defense person. Like, I don't even know that much about like missiles and like building tanks and stuff. He's like, but I'm learning as fast as I can. And he said it's a natural adjacency to the cybersecurity market, right? Like a lot of the cybersecurity stuff has some sort of relation to defense stuff. There's software built into the hardware. And what he was explaining to me is, I'm getting pulled into this because I need to tap into my network. My network is where I get the deals done. A lot of the CFOs that I knew from the cybersecurity places are moving over to these defense companies. So naturally, I have to go where the gravy train is.
And the defense tech companies are probably more more near-term IPO candidates, if I had to guess.
Yeah, that's what he said. He said M&A right now for some of these companies that he was working with before is like a total desert. And so he's looking more towards not only the IPOs of these companies, like I'm making it up, like an Anduril or something, but the follow-on debt offerings because they're so capital intensive because it's a full service bank.
He makes money based on the commissions or the kind of transaction value he's involved in. You know, cybersecurity seemed like a sure bet for a long time. Actually, what's confusing to me is like it felt like a sure bet. And I have to imagine cybersecurity is even more important right now with AI and all the sensitive data people are sending AI companies. Like, how is that not more of a lucrative position?
We talked about this. This is what breaks my brain because it's both, what did Dickens say? The best of times and the worst of times. It's the best of times in terms of cybersecurity being the number 2 initiative on every CIO's mind and CFO's mind other than AI, right? So it's AI, 1, and then like, I don't know, 5 steps down the rung, you get the B. Somehow, that's not how the alphabet goes. But either way, it's the second one, cybersecurity. So people are still buying it. The budgets aren't going down. A lot of these companies are still growing. But the multiple on publicly traded security companies in the last 18 months has fallen from like 7x to like 3 and change X. So the multiples are down despite not that much of a degradation in performance.
I feel like with security, it's one of those categories that has always had a very high retention rate. Customers been willing to lock in long-term contracts. Now it kind of feels like the best of breed security companies, like they're going through a generational change. And so it's not clear like which companies are going to be the winners and losers in this shift. And my guess is probably retention rates are, if not already coming down, like people are worried they're going to come down. Commitments are probably getting shorter. And so we're in this really odd time from a security perspective.
And then just the third anecdote, having lunch later that day with a friend who's an investor, and he just said, CJ, straight up, there's a blanket. Don't bring any pure SaaS deals to us. We're not doing them. It has to have AI or defense or hardware and compute attached to it. But we're just don't even waste your time flying out to meet with some of these SaaS companies.
And for what stage are we talking about? Is this like early stage investing or later stage?
This is Series B, C.
Oh, wow. So even at Series B and C, no SaaS. Because I mean, I'm not surprised with like a seed stage or pre-seed. Obviously, like at that stage, you want to back, what's coming. But you have to imagine there's like some pretty interesting vertical SaaS companies out there, like even now that probably have the future potential of an AI story, but they're not like primarily AI companies.
And it was weird because he was saying that is true, but we're also thinking about our reputation along with that. So it's this funny game where it's not just about, is there potential to make a return in this? It's how does it reflect on our brand saying that we are the leading AI and hardware investor for growth stage companies?
Yeah, I'm torn because you would think there's probably a really interesting growth equity opportunity right now where you've got a lot of like fairly high growing, pretty close to break even or profitable SaaS companies that the market is just totally overlooked and they need some growth capital to, get where they're trying to go. But the valuations are a fraction of what they would have been a few years ago. There's part of me that's saying like, why is it, you'd think that there would be this like money going into growth equity and really snapping up these bargain investments. But at the same time, people are probably worried about like, you can't really flip these companies in a few years like you used to be able to.
And I think they're looking at it like the upside is a lot less than it used to be. It may be a stable thing today, But if you're playing for something that's a fun returner, are you able to underwrite that?
The common thread across your three examples were like, these are successful people. My guess is
Yes.
probably people in their 30s, 40s. They've built a career, and probably not a career that's been long enough to get rich, but like they've done well for themselves. They've got promoted. They kind of did the thing they were trying to do. And now they're looking back and going, did I make the right choices?
Yeah, these are three people probably around the age of 40, all with kids in private SF schools. And they're just kind of sitting there like, I feel like there's a great reshuffling and I'm going to get lost in the shuffle if I don't play my card right.
Yeah, the elder millennials are really feeling old these days.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to beehiiv. I chose beehiiv because they're serious about powering the internet's best newsletters. beehiiv's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on beehiiv. You can host webinars on beehiiv, and you can access beehiiv through the new MCP. I just use beehiiv's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, beehiiv is a no-brainer. Try beehiiv for free by going to beehiiv.com. That's beehiiv.com. Use Kyle30 for 30% off your first 3 months.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run.
When I looked to set up my first CRM at Growth Unhinged, I knew I wanted something that was actually AI first. The world has evolved. Most CRMs are still stuck in the 90s. I found Lightfield, the CRM that remembers everything and does the work for you. It joins all my sales calls, reads my emails, and has the full context on every account. At this point, Lightfield knows my deals better than I do. I haven't had to set up a single CRM dashboard. Instead, I simply ask Lightfield questions like, which deals in my pipeline are most likely to close, or who do I need to follow up with today? It even automatically prepares me for meetings with a personalized daily briefing, and setup was quick and surprisingly painless. Lightfield is my sales coach, RevOps analyst, therapist, EA, all in one. See Lightfield for yourself with a 14-day free trial. Connecting data from your inbox takes just 5 minutes, and you can migrate in under an hour. Go to lightfield.app, that's lightfield.app, and use code MOSTLYGROWTH to get 3 months free. I've always thought about like a lot of the angst with careers right now is in the generation that's graduating from college. And so
Right.
I don't know if you saw, it was a viral incident where a graduation speaker talked about AI and got just ridiculed for it.
The rise of artificial intelligence is the next industrial revolution.
The students were not so happy about AI. And I mean, I think for college grads, it's really hard to find a job, especially for computer science grads who used to just expect to be like flooded with lucrative 6-figure offers after graduating. And so I thought about the angst being at the lower end of the market, but it's really everywhere right now.
Yeah, and I think like what that tweet definitely rubbed a lot of people the wrong way because they're like, if you're making $500K, you're a failure. Like you're never like that was a pretty sad outlook to take on things, and it also made it sound like the only point of living this life is to try to get an exit as like a venture founder or like first 10 employees at a company. Like, okay, maybe we got to step outside of our bubble a little bit. But I can corroborate that the sentiment is that like people are either getting pulled in the direction that they didn't anticipate and they're trying to figure out like their bearings and whatnot. But also they're just kind of like bummed out, which is like weird and comparing themselves to others.
Yeah, I think a lot of it is the comparison because these are people that still have good jobs. They're very well paid. But if they look at people that are maybe 5 years older than them, their peers like joined a HubSpot that maybe then went public and they would have made bank on that. Like when it went public in 2021, like the people that were just a little bit before them really had a cash out moment in SaaS. And I'm also approaching 40. I
Yeah.
personally haven't had a cash out moment in SaaS. I know a lot of people that have. It feels like the difference between who made a lot of money and kind of had this retirement level wealth event and who, is just sort of working on a salary basis. Like it's not based on merit. It's based on a lot of luck.
It's based on a lot of luck. And I think some of the people who are listening, because it is a pretty specific niche audience of people who probably work at tech companies, a lot of us got into the game for the equity payout or promise, or not even promise, the hope of equity at the end of the day, right? I hope this turns into something. And maybe you didn't take the highest base salary. Now you're like, well, A, is AI going to diminish my job in some way? B, can I learn AI fast enough to be better at my job? And then C, where will the value accrue? Will I get a higher salary because I know AI? I don't know. And then what will my equity outcome be? And if you're in your mid 30s, you have kids, you have a house, you have a mortgage, like if you live in a nice area, it's pretty easy to spend your way through that salary.
Oh, yeah. Where I live in Boston, right? Boston's an expensive city. The comparison point is very real. Even if you're well off and doing well, there's always someone doing better than you. And it's really challenging to not compare yourself. It's a weird environment because I don't think a lot of people get into SaaS because that's what they always wanted to do from when they were like age 8. It's not like they went into their elementary school and someone was like, I want to be a fireman. And someone else, I want to be a policeman. I want to be a vet. I want to work in B2B SaaS sales.
I'm passionate about B2B MarTech.
People did it because the market was growing really fast.
Yeah.
SaaS was seemed like a way more sure bet than B2C, for example, where it was a little bit more feast or famine. Felt like high retention businesses. You do work hard. You got to really like learn a lot around the product markets. Like it can be a very stressful job, especially with like your VC backers and all the competitive pressure and so on. But like you're working hard, but the meaning isn't because you necessarily love that industry. The meaning is like you think it's going to be worth something like material at the end of it.
Yes. And so what I wanted to chat with you today about is what are the different levers that people can maximize in any sort of job negotiation? Because now that I have this recruiting company too, I talk to some of the candidates, and what I notice is people are often very bad at picking like what game they're playing. And I think the worst game you can play is to not maximize for any one of the 3 or 4 that are out there. It's just to kind of like, I don't know, almost spray and pray with your chips on like, yeah, I kind of want the title, kind of want the equity. I also want a high base, and you can't always get all of them.
Before we even go through all of these examples, like a lot of the conversation today is going to assume people stay in tech. I have met a number of people that have said, "Hey, like I'm passionate about climate change or I'm passionate about X." Now is a chance to actually like try to pivot my career to use the skills I have from tech, but go into a field that like, even if the equity isn't worth anything, I feel like it's more aligned to like my vision, my values. And so I do want to say like that is a very real path. And I'm personally seeing more of that right now.
Wait, that's a good zig real quick. If we can, yeah, we can do this whenever we want. What are some examples of this? Nobody zagged into audit, right?
Yeah, no one was like, I've been helping people my whole life, and now I just want to make sure audits are as compliant as possible. I have a friend, he was in consulting with me. He then worked in tech when I was working in tech. And then he decided like he wanted to go work at a climate change startup because he felt like the work was a lot more meaningful. All of the hours he was stressed he was going to put in, you're like, yes, he would be well paid for it from a salary perspective, but really he was feeling like the work was meaningful above and beyond the compensation. And being able to have that meaning, I think means the equity piece, it's just all upside. It's all gravy because you're much more passionate, and you're generally working with people who are also passionate about the work you're doing. And so it doesn't need to be like climate tech, but some folks are just looking at industries that are more relevant for like what they want to do. Maybe they're going into media, like a solopreneur lifestyle where they're kind of freelance and working with multiple clients, but also able to be a digital nomad, or like just move somewhere that's a lower cost city and just like have more flexibility in their life. Like now it's sort of it's like an interesting reshuffling moment right now. I do have to say, it is a good time to not live in San Francisco. I don't have Boston friends that work in tech. None of my neighbors. I'm in like this really hippie green neighborhood in Boston, and I don't meet a tech worker. I feel like if I looked like I work in tech, I would get like made fun of for that. It's a lot of people that work at nonprofits. Education is huge in Boston, obviously. Healthcare, pharma is big in Boston. So I meet like smart, accomplished people, but just not people that work in AI.
Dude, I'm recording this from like a retirement home in Naples, Florida. Not only am I the only person who works in tech, I'm the only person on this Monday working.
Oh man. We want to talk about like advice we'd give, or just helping people that are in this great reshuffling, that are thinking about what to do with their career and how to make the right decision, or at least a decision they're going to be happy with. One thing that comes to mind for me right now is like, do you go work at that fast growing AI company where your equity could be worth a ton of money, right? Or do you stick it out at that maybe SaaS company that is more at scale, more stable, but valuations have come down and it's nowhere near what it used to look like?
What I go through are the different levers to maximize within the example you just gave, right? Because they're going to be different, and we can use your example as like a scaffold for it. So the first one is you can maximize on your total equity comp, like the potential for the outcome there. So that would be the play to join like an Anthropic or something, right? Actually, probably would have had to do it like 3 or 4 years ago.
It's worth like what, $1 trillion right now. So how much upside is there going to be in this thing?
It's up like 45% in the last like 6 weeks. So who knows? I was on the street corner in San Francisco with my buddy, and he's like, I have an opportunity to put $25,000 into OpenAI, but it's at $85 billion. I'm like, bro, no way this thing can go any higher. Man, woo, I think you're going to top tick it.
Did you see the rumors that they were thinking about a reverse auction model? I don't know if this is real or fake, but I saw some tweets about it. They were looking to see if it was like legal to do a reverse auction where they'd start at a really high price, see how much demand was there, and then steadily drop the valuation to like incrementally get more and more. I need to verify if that's real.
Well, that warms my finance heart if they are. I'm more of a Dutch auction guy myself. That's one lever you can pull. The next one is your base cash comp. Like, I just want to print a massive effing W-2. And it's a lot easier to do that at a company that is like steady Eddie, going along, maybe not growing 100%, but it's like over 500 million in revenue, and you can take on a big title.
And when you're thinking about that, is that salary plus bonus, just kind of cash?
Salary plus bonus, something that is going to print and go to your bank account at the end of the year that will be liquid, right? There's a calendar event towards it. You get paid every 2 weeks, and then you get a bonus at the end of the year. You can maximize that. So that could be a late stage startup. And then the third one is the title and the opportunity to just go and prove yourself and like take on way more than like a reasonable person would trust you with. And I think within each of these three, there are different types of companies and different settings that you have to keep an eye out for in order to maximize them.
You missed a pretty big thing to optimize for, CJ.
Equity, cash, title/experience. What are you going to say, like lifestyle or some bullshit like that?
Your token allowance. And that actually does seem to be a real thing for engineers right now, which is so wild to me. But no, I mean, okay, those are all very real considerations. I do think that lifestyle and like, is the CEO that you're going to be working for, like, are you philosophically aligned with them? And are they charismatic? Are they someone that's reasonable? So you would mention like an ability to take on a lot of stuff and kind of grow in your role. I also think about like an ability to just have autonomy, hire people within your team versus are you doing everything yourself? I think there's like a lot that kind of gets into that. And to me, I've always been someone that's been willing to sacrifice comp for that like better lifestyle and better working environment, because I just don't feel like I'm going to do my best work otherwise.
At Veeam, I went for the W-2 because it was at a time in my life where I was like, I need some cash here to live in Boston and stuff. I didn't even have equity there. Didn't give any equity to really anybody except if you were in management. At Sneak, I went all for the equity and maxed that out. And in fact, I gave up some of my salary because they had like options at the time of where you could give up X thousands of dollars per year to get more equity. So I went all for the equity. And then at Parts Tech, I'm like, I just care about the title, baby. I just want to be a CFO. I want to be able to hire a team. I want someone to throw me the keys and just let me run around and do stuff. And I will take probably less money than someone who's a senior director at like, I don't know, I'm making it up, like a bigger later stage company would make. So it wasn't even about that. And there was some equity upside.
I thought you took that job because you wanted to work with me.
I did. You pressured me into it and you said, CJ, I will only recommend your Substack if you take the CFO position.
Hey, those extra subscribers are actually worth a lot.
It actually was. They were probably the best bet I made. If I risk adjust all of that, it was probably that.
My career choices have been odd. I haven't changed jobs very much. So I took a job in pricing strategy consulting after undergrad. The entry pay was 58 grand was the base, which is now like, that's like an SDR salary. But this 15 years ago, that was like decent. I could afford an apartment with a roommate in Boston, well, Somerville, but close enough. But took a job at 58K, but I did it because I wanted to work in strategy consulting, and Bain, BCG McKinsey all turned me down. So I wanted to work in strategy consulting. I also just got a sense that like the people there were really smart, really passionate about what they did. There was also the firm was growing like a weed. And so there was a ton of promotion opportunity for people that did well. And that also meant you had a lot of ability to have an impact. So like I could present to a client at the age of 23 and lead a project at the age of 24. And I would not have been doing that at a bigger consulting firm. So I started at 58K. I got promoted 5 times, I think, in 6 years. So I got promoted, like there's 4 levels of consultants, and then senior consultant, manager, director. I got kind of through all of those promotions within 5 years. And so my compensation had 3.5x within a 5-year period. And so that all really played out, but I was doing that at the expense of like well-being and sanity, and the hours got crazy. The stress was insane to be 27 and doing the work that I was doing. It was completely burning me out. I was on a plane almost every single week. I think I spent 10 days in a row in Atlanta working from like 8 a.m. to like 10 p.m. for 10 days in a row. And I was based in Boston, but working out of Atlanta to be close to the client site. That was like enough for me to want to leave. So then I joined it. I took a pay cut to join venture. I actually took a pretty significant pay cut, and I took a pretty significant responsibility cut. The role initially that I was hired for was called market strategist. So like I had this director title. I dropped down to a market strategist title at lower comp, but I figured the role could be what I made it. Like I'd be working with the portfolio. If I was impactful with the portfolio companies, and if I could like share my voice on the kind of the OpenView platform, I felt like I would have a growth path both within OpenView and then just also externally. So I did that, but then I stayed at OpenView for, nearly 9 years. I optimized for places that I could see myself wanting to work at for a while, and knowing that like initial comp is not where you're going to end up.
By the way, you make the largest jump typically in tech companies when you change jobs. You can usually get like a 20 to 30% bump if you play your cards right.
And I did the opposite. People think venture pays well. It can pay well, but it actually doesn't pay as well as people think. The value is often in the equity, which is uncertain, obviously. Venture firms don't have like massive amounts of fees that they can play around with.
So if you take a look at your career journey, I know both of us are doing something that we didn't know was a career coming out of college or maybe even a couple of years ago. But do you think there's arbitrage for people today in the current landscape if they're sizing up these types of opportunities, knowing what to maximize for?
The arbitrage, like it used to be, take like a Series B company that has a great investor and like really good unit economics, and you're honestly
ride that horse.
You could probably ride that horse to a good payout. I didn't do that, but that would have been a pretty safe strategy for a while. I do have to say, if I was at a SaaS company right now, I would want to work at a very fast growing, innovative AI company that had a technical advantage over the rest of the market, and not a lot of like, I mean, obviously I work in go to market, but like, so not a lot of go to market DNA, or like DNA for whatever the function I was in, could be finance, could be whatever it is. That's just going to be an education. Like, even just being in that environment is going to be such a massive education. And it's, to me, going to be equivalent to where you went to college. Like, if you pick a really hot AI startup right now, that next job is going to look at you as if you just graduated from Harvard or Stanford. And so, like, to me, that is such an important stepping stone for a lot of people. The other thing that's, I think, an advantage, while the equity might be worth a lot, realistically, these AI native companies have a massive ARR per employee. And so they're paying quite attractive salaries, just equity aside. And so I think of that as probably the best arbitrage right now.
I just want to drill on one point there. So they are, from what you're saying, they are paying pretty good base salary. It's not like when I joined a Series B startup, I was like, you know what, Cat, I can make it by on this. It's really about the equity.
It does really depend on the company, but these hot AI startups are raising record Series Bs, like record Series As. Like, the cash that these companies have on hand is often so disconnected from like the letter on the round. And so I do think a lot of them are paying quite well. The expectations are going to be higher. They're going to also want you to be AI native, probably take on a lot more work yourself with help from AI, as opposed to like hiring a massive team. So there's going to be different expectations. Some of these are 996 companies, so you would have to factor that in. That's not what we were accustomed to in SaaS, but that is the case. Like with AI, I mean, I see it on a consulting basis. I'm in Slack with a number of companies I work with, and I see when they post on Slack. I see when the founder puts stuff in Slack. I'm like, oh, like these people are really working around the clock. So you have to, I think, sacrifice a lot to work in some of these environments. But even if you put in, 18 months, if you can stick it out 18 months, the long-term value of that is huge.
Yeah. If you make it 2 years, you're in the club. That's how I look at it.
Exactly. And it's one of those things where I think it's going to be really uncomfortable for a lot of people. But sometimes when you see how AI native companies operate, for good or bad, like not everything they do is perfect, but like when you see how they operate, it really helps you grok how this is a different style of company. Like, I remember being in a meeting with a company and they pushed the changes to the pricing page live via cursor in the meeting, and seeing that change in real time. Like, this wasn't debating pricing like for 3 months and having this like detailed implementation plan. Like, they were just like, you know what, this sounds like a good idea, let's ship it, let's see how it goes. Now, that's probably not what I recommend for every company to do, but it just shows like the speed of operating and the AI first sort of approach, and how the philosophy for a lot of these companies is that the cost of inaction is often higher than the cost of acting and getting it wrong and rolling it back. And so as long as like you're making a thoughtful decision that you believe is right and that you can roll it back, like, why not move forward aggressively? So anyway, I just think you can retrain yourself by being in one of these companies.
A lot of people don't feel confident, though, that they're picking the right one.
That is a good thing to not feel confident in. Realistically, it's hard to guess who are the right ones right now, right? Like, look at some of these, and the growth rate is fantastic in many companies, but there's a lot of companies in a category that are growing really fast. Even within customer support, like Intercom, which we rebranded to Fin, growing really fast. They are saying that Fin is above 100 million ARR, but Decagon is valued at multiple billion. I think Sierra is valued at like something crazy, like 18 billion. There's Parloa, there's Forethought, there's Ada, there's like all of these companies that are really well funded. Now, not all of these are probably going to make it, if I had to guess. And so it's tough because the external signals indicate like this has the VC stamp of approval, but that doesn't necessarily mean it's going to be the winner.
This is something I discussed with Sam Jacobs on Run the Numbers of Pavilion. Kyle, do you think it's possible to have a great job at a bad company?
This is a good question. So I think it is, but I think that the career value is much higher being a mediocre employee at a great company than being a great employee at a bad company. Like,
Yeah.
And that's a really tough like thing to wrap your head around. Being like the big fish in the small pond feels awesome, but just in tech, so much of the returns go to the top tier of companies, and even just witnessing how those companies grow and seeing the playbook makes you really valuable to a lot of other companies.
Sam had described to me that he's like, I worked at 3 shitty companies in succession, but at all of them, like, they paid me over $1 million a year to work at each one. So he's like, I knew what I was signing up for, and I knew what I was maximizing for. He's like, that's just the game I decided to play, right, wrong, or indifferent.
I do say in sales roles, if you can sell the product of a pretty shitty company, like that is the AE that I want to hire anywhere else. Like, don't send me the Anthropic sales reps. Like, they have no experience selling something that like people aren't clamoring to buy. Send me the person that's selling like the ERP that's like the number 5 player in their space, get crushing
Yeah.
quota. That's a great hire.
Person selling Ping identity.
So there is something to that. For salespeople, like it can actually be an advantage. If you can consistently hit your number, that can be an advantage. But wouldn't you want to just sell a product that has like an amazing lead volume of highly qualified leads, crazy high win rate, fast sales cycle? Like, you're probably going to get a much higher bonus payment.
I want to hire the rep selling $3 million a year in NetApp.
The one rep.
Yeah, right. Okay, maybe gearing towards the close, one other question for you. Is it possible to have a great and rewarding career at a company in its twilight years?
Great and rewarding career.
I'll give you an example of this. So I spoke to Bruno, Annicq, CFO now of Wellhub. He left McKinsey to go work at AOL during like not AOL's hot years. Like, we're talking like post couple failed merger agreements AOL. And he went in and just like ran all over the place, did cool stuff and owned a bunch of stuff. And it worked out for him. He ended up getting a really cool CFO job coming out of that. But like, he called it the cockroach of the internet. That's what he called it.
It really depends on the role. Like, if you're early in your career and you're like a sales rep, for example, not a whole lot of executive visibility into what's going on, not a lot of control, right? That would be the last place I'd want to join. But if you're like the number 2 to the CEO, and like the CEO is brought in with a mandate to change things,
That's what he
and
was.
you get to witness it all, and the only way you're even able to be the number 2 to the CEO is because it's a failing company, that's a great learning experience. I would guess I would look at like, who are the people around the table? What is the role? How much control do you have over your destiny? And are people aligned on the expectations going forward so that you're not held to an unfair standard after it all happens?
Because I'm wondering if there are people who are bummed out right now that they didn't choose to work at OpenAI or Anthropic 5 years ago, if that was even an option, who like, they should be looking at a different way. Maybe you should go and be the number 2 at Arctic Wolf. I don't know.
That's a hard sell for me. I mean, you could become a specialist there. I know some people that were CEOs in turnaround companies.
Yes.
That's a really hard job to have. Like, you're brought in by the PE firm or the venture firm when like the company's kind of failing, they're flatlining, revenue's declining, and you have to like totally figure things out. I think that there's like a really interesting creative problem solving aspect there. And often like these people are well compensated if they have performance. So there's like a fun little like aspect of what can you do with this business that's really interesting to me. And so I think they like the work they're doing quite a bit, and it feels meaningful to change the trajectory of a company. But yeah, it's not the safe bet.
Yeah.
So, all right. So based on this, if you're joining a company, if you're, shutting down Mostly Media Inc., where do you join? What do you optimize for?
Dude, I think it's the best time ever to be a small business owner. I really do. This is like not at all what you asked, but like an example is I was catching up with my buddy, Terrence. He was saying he called his favorite pizza place down the road, and the person who picked up was like very jolly and like blah, 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 took his order, gave the exact thing. He said, can you just read it back to me because it's kind of a complicated order? And they said, it's this pizza, blah, blah, blah. And I told you it would be ready in 22 minutes. He's like, wait, something's off there. That's a very specific time, and it gave me back more information than I asked for. I just asked them to repeat the order. So he goes in the pizza shop. He's like, hey, what's up, Jim? Because he goes there all the time. And he notices, he's like, there's no one else in the shop right now. He goes, that wasn't you that picked up the phone, was it? And he's like, no, that wasn't me. He's like, is someone else working here with you? He's like, no, we installed AI to take the calls over the phone. And so this is a pizza shop in Naples, right? Not the most tech leaning place. He's like, that must have been like an arm and a leg to do. And he said, it was like an $8,000 one-time implementation. And then after that, it's $500 a month. And he's like, oh, wow, that actually is a lot. He's like, actually, no, because I don't have to have the two unreliable people I used to have working the front desk who are always quitting their job or showing up late. And on top of that, I used to have to pay for 5 phone lines so they continually pick them up and take the orders during busy times. This right now, I can man the oven, the orders come in, it's actually cheaper in the long term. And so it made me think that like, you don't have to leave tech to do stuff, but like there is a world where you can be a lot more efficient in whatever you're working on your own, and the value can accrue to you.
Yeah, I mean, I think that lifestyle businesses got dragged for a while as like, what are you building a lifestyle business? Now it seems like the kind of the flex in the industry, because a single person can build something really cool. They can build tech products, they can build media products. Like you can build something with a network of like freelancers, contractors, part-time hires, and then just AI tools, and like build a kind of a cool, interesting life on that. So I do feel like being an entrepreneur of some kind like is definitionally rewarding. I'm loving it too.
Yeah, but good times, bad times, doesn't matter. Just know what game you're playing and maximize for that lever. Can't be everything to everyone.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give us 5 stars. It only takes like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a good day.